Okay. So, as I've said, I'm just repeating the end of the last slide there. There's a partly deterministic, highly nonlinear system going on there, so we need a theory that handles that. And why do most economists still cling to this stuff? Well, the reason is it fits the belief they've always had about how the economy operates, that it's an equilibrium. And if you notice how Sharpe justified this theory in the first instance, with all the crazy assumptions, he said it was justified on the basis of a methodology that says you don't need to worry about assumptions. But he said, I like this theory because it agrees with our theory, not because it agrees with the data. Look down here, he says, assumptions are irrelevant and the results imply conditions that form a part of classical financial doctrine. Not that it fitted the data at all, okay? But when you look at the testing it by using the data, along comes Eugene Fama. You know that name fairly well, I imagine. And Fama argues that it does fit the data so well that it's actually not just a good first approximation, but a second approximation, meaning it's very, very close to the actual data and very little information contradicts it. And to reach that conclusion, he looked at stock market data up till 1966, but starting in the 50s, after the Second World War, well after the Second World War. Well, let's take a look at the longer term data that I've showed you for the Dow Jones. That's again, another exponential fit to the data. And you can see that the actual data is well above or well below, except for that little period around the 50s, when it was pretty close. Had a slightly, if you actually look at that little segment, it's got a steeper slope than the overall data. And Sharpe's paper came out about here. Fama's is published a few years later. And the data window that Fama used is that window there. Now, looking at that window alone, the CAPM fit isn't too bad. Justifies what he had to say. But of course, when you extend on further, then you get the crash of 73, first of all, not long after, when the market fell 45% in 23 months. And you then have this exponential takeoff, virtually, a bubble, but nobody can deny it's a bubble now, taking enough in 1982, and by the time you get to the early 2000s, it's about 21 years ahead of that long-term trend. And of course, the CAPM fit isn't so hot. So having chosen that little data segment to begin with and said it's really good, having ignored, by the way, the data point that did exist, now he's got to come to terms with the overall data. Now, Sharpe's assumptions here, those wonderful little simplifying assumptions, a common pure rate of interest, and homogeneity of expectations, meaning you all agree on what's going to happen to all shares. And his defence of them was that they're unrealistic, of course, but the proper test of a theory is not the realism of its assumptions, but the acceptability of its implications. What a piece of waffle that is. So how valid is that methodologically? The other half of the justification. Well, he's appealing to Milton Friedman's stuff on methodology, which is one of the readings you'll find for this course. And Milton argued that not only is realism irrelevant, he said often the more unrealistic assumptions, the more powerful the theory. And that's what Samuelson later called the F-twist, that the more absurd your assumptions are, the better your theory. Now, that's the defence that Sharpe invoked. He said it's okay to assume those things so long as the model fits the data. Well, to go through the methodology itself, as opposed to looking at before we look at the data, that defence of what's called instrumentalism is itself false. Because for a start, as I showed you when I was explaining how you show that the square root of 2 is not a rational number, and therefore you can also show that you can't aggregate consumer preferences to get a downward sloping market demand curve, you can challenge the logical consistency of assumptions. The proof by contradiction example I showed you, also the stuff about the theory of the firm. There's fallacies there in going from a so-called horizontal demand curve, which you can't get, to a downward sloping market demand curve. Likewise, you can't assume that all investors are the same to aggregate. That isn't aggregation. It's a logical contradiction of your starting point instead. And also, scientists do attempt to build theories which are essential descriptions of reality. So even though people regard quantum mechanics as extremely weird, when you look at the various things that can happen in a quantum mechanical system, they still believe the universe is quantum mechanical. They're not saying it's a mad model we've made up that seems to fit the data. And the important thing for Friedman as well is that if you look carefully at assumptions, you can pull apart Friedman's logic. And a guy called Musgrave did this back in 1981. And he said, let's look more carefully at the types of assumptions you can make. And he said, there's pretty much three classes. There are assumptions which are negligibility assumptions, what he called domain assumptions, and finally heuristic assumptions. And he said, which class of those assumptions does Friedman's methodology apply to? Well, a negligibility assumption is an assertion that something that you're ignoring is of little importance. For example, you ignore outliers. Okay? As I've shown you, you can't disregard the outliers in the stock market, you'll miss 90% of the action. But you can ignore, for example, that there's atmosphere on the planet when you drop two lead weights off a height of about 100 metres to see which one hits the ground first, when the prevailing theory says the heavier one will hit first, because heavy things fall more quickly, which was the pre-Galilean theory about how things fell to Earth. And Galileo dropped them out, two different sized lead balls at the Leaning Tower of Pisa. I believe the small one hit the ground first, if indeed the experiment occurred. That's one of these things we're not really sure whether it actually took place or not. But what he was doing in doing that is assuming, quite correctly, that he could ignore wind resistance. So that's a classic case of a negligibility assumption. A domain assumption, on the other hand, asserts that something will happen if the condition is true. So, for example, if I assume there's no atmosphere and I drop two feathers, or a feather and a lead weight, and say they're going to both fall at the same ground at the same time, if there is an atmosphere, I'm going to be wrong. If the experiment would work on the moon, if I dropped a feather and a lead weight on the moon, they'd both hit the ground at the same time. Okay? So that's a domain assumption. Very different sort of thing. Now, a good example of that in terms of one other part of Friedman's logic as well, he argued that the more absurd the assumptions, the better the theory. Sometimes you get a very, very much richer theory by being more realistic in your assumptions. So, for example, when Newton developed the theory of gravitation, he assumed there's only one planet. And he then developed a completely deterministic equation for the path of the Earth or a planet around a sun. And it described an elliptical path. And that was a major achievement compared to what was known before Newton came along, one of the greatest achievements in the history of mathematics and science. Now, in fact, the orbits aren't perfectly elliptical, and it's also false that there's only one planet circling our sun. So a problem was set up, can you write an equation for more than one planet? And people tried for so long and failed that finally the King of France, I'm not quite certain which one it was, put out a prize worth 100,000 francs to the first person who could solve it. That was when 100,000 francs was a seriously large amount of money. It was finally won by Henri Poincaré, one of the world's greatest mathematicians, in 1899. And what he showed was there is no formula. He proved there could be no formula. And he also proved the paths are chaotic. If you have a multi-planet system, then those paths are going to be all over the place, meaning the planets will collide with each other. Now, of course, the fact that we don't have colliding planets in our solar system shows that the planets we've actually got must have evolved from those collisions. They must now be in orbits that are no longer intersecting for some evolutionary reason, rather than the mathematics of the orbiting of a sun. And they're roughly elliptical, but the absence of the collisions is actually now explained by elements of chaos theory. And we can now understand that the Earth is a very unusual planet again, because its core contains the core of two planets, two smaller planets, while its moon has no core at all. And that's a major part of why life can evolve on this planet, because that core generates a large magnetic field that deflects a lot of the radiation from the Earth, from the sun, and lets life evolve here. So you get a much richer theory when you have a slightly more realistic set of assumptions. Now, heuristic is the final type of assumption that Musgrave talked about, and that's where you make a knowingly false assumption on the way to building a more general theory by dropping that assumption. So, for example, Einstein has written a beautiful little book called Relativity, and a simple explanation that any intelligent person can understand. That's the title of the book. He's dead right, got enough brain power, you can sit down, you can read it and understand it. Don't even attempt to read the one he wrote for physics majors. I did that once, and mathematics was completely beyond me. But this one, quite readable. And he said, imagine we're starting assuming that the distance that a person will cover when they walk across a train carriage or the distance covered by a projectile when you fire it out horizontally away from a rocket that's also going forward, will equal the trigonometric sum of the forward motion plus of the actual platform plus the sideways motion of the person or the projectile. So you look at it in terms of a train, there's the forward motion of the train. No one considering a rocket doing 9/10 the speed of light. There's the horizontal movement of a person walking across the carriage. There's a projectile being fired from that rocket also at 9/10 the speed of light. We know the sum trigonometrically going to be pretty damn close to the actual speed the person's doing. We know that that projectile will be doing less than one times the speed of light. So science was made have worked out at this starting point. We have a knowingly false law, which we'll presume holds in the meantime, and then see how we have to modify that law to make it fit the actual situation. And that's how we derived E equals mc squared. Now what about the efficient markets hypothesis? They assumed all investors have exactly the same expectations and they're accurate. Okay? Not they had the same wrong expectations, the same correct expectations about the future, and the same access to credit. Are they negligible assumptions, domain or heuristic? Well, negligibility, not really. Ask Sharp what happens if you drop them, and he says the theory's in a shambles. That's not what happens when you drop a negligibility assumption. Galileo got it right. Okay, assumed there was no resistance from the atmosphere. That was good enough for the situation he was looking at. Heuristic, well, it would have been good if that was the case. You could have started from that assumption and then said, let's generalise it now to where people have differing expectations, differing access to credit, and then see what sort of theory you get out of that. Maybe replace risk with uncertainty or take account of those expectations. No, they didn't, and that's why their CAPM failed fundamentally at the end. So what it really was the domain assumption. If you can find a planet or a universe in which everybody is God, then the CAPM will work there. Until you find that universe, it's false. So it's a domain assumption. It's not going to apply on our planet. Now, despite that reality, the methodology itself was false, the evidence did seem, the data did seem to favour the various CAPM ideas of prices reflecting future earnings, shares with the higher return being more correlated to the trade cycle, and investors choosing on the basis of a risk-return trade-off, and that seemed to work. And there was that positive relationship between return and the degree of volatility. But I think it's actually a fluke of the data that was used by Sharp in the first instance, because Sharp paper was published in 64, the Fama papers in 69, and what you had from 49 to 65 was a steady advance, very fast steady advance, a 467% increase over 17 years. And that continued for 2 years later, and then you had stagnant stocks for quite some time, with Fama's very enthusiastic paper using data from 50 to 66. Let's take a close look at that data. Here's the conclusion from Fama, the same argument that the assumptions don't matter, and that the model's a good guide, and that it's conclusive. He admitted to one anomaly. I'm going to highlight this for a good reason later on. He said large movements one day were often followed by large movements the next, which is precisely what we're seeing right now in the middle of the period of volatility we've got happening in August 2011. And that was the one departure he's willing to notice. But he said, well, in effect, what he's saying here is that those things will cancel each other out. It's not going to be a random walk, but the market can still be efficient. And because the one goes one up and one down, it seems like an unbiased adjustment. Okay? You know, big up, big down cancel each other out, and you can ignore them. The same sort of case that they like making about outliers. Well, let's look at the data from 50 to 66. There's still some pretty big booms and crashes there. You can see a pretty sharp one in the 63-64 period, and also in the mid 57-58. Over the entire time period, pretty hard to argue that one up there was a random experience, or the one we can see here. Well, let's use logs and look at the daily change now. That's the daily movements from 1950 to 1966, with the vertical axis showing the percentage movements up or down and the horizontal being the time. Here's the daily movements from 1914 to 2011 now. I've extended the data somewhat. Bit different. There's the bit that Fama looked at. And as you can see, there's only a couple of events there that are outside the -5 percentage movement. But let's superimpose simulated data on the actual now. That's the percentage daily movement in the Dow Jones across the period that Fama looked at, with the blue line being my simulated data, with the same mean and the same standard deviation. Let's do the same thing from 1914 to 2009. And there's some pretty big differences there. That's the period that Fama looked at. That is a very stable period in the index's history. And the fit looks okay. There's a few anomalies there, and you can rule those out. You can knock them off as outliers. But not so for the entire period. It's a terrible fit, particularly with those enormous movements in the 30s, the late 80s, and of course 2000, and now what's happening at the moment. There's far too many outliers to say you can ignore the plus and minus 5 sigma events. Again, the daily indicators look okay. Here's taking a look at the simulated data. It's still a big gap. That's looking at 50 to 66 data on the simulated, which is the red line, versus the blue, which is the actual, the percentage movements and how many movements there were of that scale. But there's about 40 or so that are outside the range. Not too bad out of that time series, you might think. Here's the entire time series. And of course you get enormous movements, far, far bigger than the random prediction. There's over 400 events that are far bigger than the random prediction would say can happen, versus less than 50 in that range, and of course a smaller magnitude as well. And the biggest there, of course, 22.6%, the biggest over here, -6.5. So the sample of data he used was a very lucky sample. Again, you can knock off the outliers, and you can argue you haven't changed the data all that much. You can be wrong, of course, but very, very hard to get away with it when you look over the entire time period. I think you'll find if you talk to your lecturers who take a more conventional approach to finance and ask them whether they should include the 30s, you've told that's an outlier. Okay, too unstable. Let's look at the data outside that range. Now here's again actual versus, again taking another way of looking at the same thing. These are the biggest movements in the actual data across that time period. When I do a simulated range, I actually get an overlap now. For the entire time period there's no overlap, but the biggest of the simulated is -2.8185, and down here about number 20 or so I've got -2.147, which is a smaller number. So there's an overlap. Again, you can get away with saying it's a random distribution. So there's -2.185, and you look down here and you can find that particular event was actually smaller than the biggest prediction from a random distribution. But across 1914 to 2009, you get far more huge movements. That's again looking from 1914 to 2009. Those are the movements, simulated data. The maximum movement in the simulated data doesn't even occur in the top 100 of the actual data. So the 100's biggest daily movements were far bigger than the worst prediction you can get from a random model. So it was a statistical aberration. The period of time used was too short, and it was too stable, with a period of low debt and high financial resilience. If you look at the balance sheets of American companies back then, which of course the theory says you can ignore, they were carrying far more debt than they're carrying now. And so is the household sector. And there's much less speculation going on. Over the entire period, of course, we had big crashes in 29, 87, 2000, 2008, and again now. And those were periods, occasional periods of extremely high speculation, and back in the 20s in particular, a very high level of debt. Now, once you're forced to look at the entire data range, your mind has to change. And I don't think this has turned up in your textbooks. I do hope it's turning up in your other finance lectures. In 2004, Fama admitted empirical defeat. Here's his argument with French in the Journal of Economic Surveys, which is a very prestigious journal. You get invited to write posts there, and it's supposed to be the reference material on a particular topic. And writing in 2004, they said, the CAPM gives pleasing predictions, but unfortunately the empirical record is poor enough to invalidate the way it's used in applications. He said, now what I find intriguing is he's willing to admit in this paper that maybe the assumptions do matter, because maybe the simplifying assumptions cause the problem. But he said whether it's those assumptions or the empirical implementation, the failure mean that most applications are invalid. And now he starts discussing the assumptions, the stuff he dismissed first of all. So he said the first assumption is complete agreement. Given the markets in time t minus 1, investors agree on what's going to happen in time t. But here's the punchline, the one that he didn't see in Sharp. And this distribution is the true one. In other words, we're assuming people can accurately predict the future. So, assumptions that didn't matter are now crucial. And he also considers, can you get rid of the unlimited borrowing by, say, unlimited short selling? He said, well, that's as unrealistic as unlimited borrowing. So he rules out a potential assumption on the basis of its realism. Well, it took him 50 years to get there. So once you get that result, you can't get an efficient portfolio anymore. So on that particular basis alone, you can't actually work out the so-called measuring stick that's going to give you a relationship in the first place. But given all that, he says, well, maybe the data can still save us. Unfortunately, what he's reporting in this paper is no, it doesn't. So he said, given all those assumptions, you know, these are clearly impediments to the theory's success now, rather than things you can ignore. But test against the data, you find that it strongly contradicts CAPM. Returns aren't related to betas. Other variables that CAPM rules out do matter. And the risk-return trade-off either is far flatter than it should be, or when you sort the data according to other parameters, it disappears. So he said there are three implications you can look at. The idea that expected returns are linearly, my voice is getting going here, linearly related to their betas, and no other variable has explanatory power. Secondly, the beta premium is positive. So the more risk you take on, the higher the return you get. And thirdly, assets that aren't correlated with the market return the pure interest rate, and the ones that give you a higher have followed the beta. Now he said, well, there is a positive relationship when you look at the data, but it's too flat. So the intercept is a risk-free rate on the coefficient of the beta. He said what you find is the intercept in the actual data is higher, and the slope of the line is lower. So if you graph it, this is the sort of result you get. The theory's prediction is the straight line you can see. This is taken from Fama and French's paper. The dotted line is the actual data broken down into bins. And you can see that as a result, you get a higher return from low volatility and a lower return than you'd like to get from high volatility. So if you actually use the beta as a guide to how much risk you give somebody, you're giving them either too much or too little risk. They're better off having a lower volatility portfolio. Secondly, there are many other things that explain returns better than the beta does. They don't actually add marginal contribution to explanatory power, they're stronger than beta. Now they talk about a whole lot of them in an earlier paper, and they say size, price to earnings ratio, debt to equity and book to market all add to the explanatory power. The best example they give in this paper is what happens if you ignore beta and simply rank portfolios on the basis of their book to market valuations. So a company with a high book to market valuation, you could break it up and sell it for more than it would cost you to buy the shares, okay, that sort of thing. One with a low book to market ratio, it's got almost no assets but it's worth $1 billion. Pet.com and stuff like that. Now when he does that, you see what he finds is the average return when you rank them from low to from a very low book to market ratio to a high, you get a very impressive return. The higher the book to market ratio is, the better the return you get. And the positive relationship between the betas of those stocks disappears. So in fact, the portfolio with the lowest book to market ratio has the highest beta but the lowest average return. So you're far better off using book to market ratios to work out what to do than you are using CAPM or the beta calculation. And the returns again are far from what the theory itself predicts. Now the best way to see that again is a graph, and here's looking at portfolios now broken down between the best and the worst book to market ratio. they're numbered for that reason. And the beta of those stocks is then shown on the horizontal axis and the annual return on the vertical. Now you notice you get a very high beta with the lowest book to market ratio and a very low return. That's one down here. On the other hand, you go for the highest book to market ratio, you get a very high return and a lower beta. And the best combination seems to be out here somewhere. And the 8th decile, where you get an extremely low beta and quite a high return. So the relationship of anything is a non-linear one doing that. But if you do a linear correlation of that data, this is the sort of relationship you'd find between risk and return. Not good, okay? So the end result of this work by Fama and French is to say we should not use CAPM. And points out, for example, using CAPM to work out the cost of equity leads to numbers that are strictly wrong for both extremes of the book-to-market valuation. Now here we go, falling back into old ways of belief. He then says, nonetheless, it's a theoretical tour de force. No, it's not. It's a tour de farce. Only an economist could believe a theory as nutty as that is a tour de force. There's a couple of tricky bits in working it out. There's a bit of interesting mathematics. You compare that to Einstein's general theory of relativity and it belongs in the toilet. It belongs in the toilet anyway because it completely distorts the data. So they continue teaching something they know to be wrong, rather than saying let's just go out there and see what else might be around that might give us a better explanation. So having said it's attractive and all that sort of jazz, again they say it simply can't be used. And here's, again, I think the two best charts to show how wrong it is. Even when you rank it without trying to sort the data in any other way, the beta is giving you seriously wrong predictions. And when you rank it by book to market ratio, you get the opposite advice that you get out of CAPM. And it looks like, talking empirically, you're best to go to about the 7th or 8th decile in a ranking of book to market ratios to get a lower volatility and a higher return. And that's what a certain guy called Warren Buffett has been doing for a very long time, making a mockery of all these sorts of theories. So, believe it or not, the founding fathers of this area have abandoned their child. Why on earth are you still being taught it in other courses? Well, I think the reason is a lot of people don't even know this has happened. One reason I get you to read the originals in this course is that I have read, not everything, but pretty damn close to everything in the literature that's worth taking a look at, despite the fact that some of it made me feel like going again to the same little room in the house occasionally. And I know what's been the literature. Most economists simply accept that the theory justifies what they read in the textbooks, and they read their own area in very great detail, so they'll be very good experts about their own particular niche, but they don't read the overall literature and they think it's okay. Now, even if they do read the literature, they often have the reaction you saw from Fama a moment ago of not knowing there are alternatives. So Fama himself possibly knows what a power law is, but I doubt that he knows, for example, what a Silas distribution is, or what's being done by econophysicists now. So they don't read outside economics either. And there's plenty of work being done by non-economists to get different models of how finance markets behave. So alternatives do exist. These are three. I'll be mentioning some of these in the next couple of lectures. And economics, of course, what comes out of this is that a key aspect of the capital asset pricing model is to tell you that how investments are financed doesn't affect the value of firms, and that finance therefore doesn't affect economics. Now, since it's false, finance does affect economics. So the rest of the course, as I go on further through the course, I'm going to be giving you ways in which finance and economics affect each other.